Hi folks, thank you very much for joining us today, where we're going to be having a discussion here about how in-house banking solutions can drive efficiencies within multinational organisations. My name is Justin Callaghan and I'm the Chief Executive Officer here at FTI Treasury, and I'm delighted to be joined today by Eileen Murray, who is one of our senior managers in our front office trading team. Here at FTI Treasury, we often come across the same pain points with clients. When we look at a world that's becoming much more complex from a banking and regulatory perspective, and then coupled with a continuing merging and acquisition environment whereby new territories are being gained quickly by multinationals, we can see that the treasurer is really being pushed on all sides in order to be able to get cash visibility, to know where their cash is and to be able to stand over the safety of that cash, and indeed to be able to put their hands on that cash and use it to the best efficiencies. So we often see those same issues arising time and time again, and we help clients to solve those issues by helping them implement in-house banking structures. Eileen is at the coalface of this, really. She manages on a day-to-day basis these structures and sees both the pain points, the solutions and the benefits, I think, Eileen, it's fair to say. Yeah. So we might start with the first one of them. I mean, what are the common pain points that you would see that are trying to be solved?
So I suppose the standout pain points are meeting a company and they have a very fragmented bank account structure. And with that, everything is spread out and there's very little visibility, and you have local restrictions and requirements that need to be met. There's trapped liquidity in that sense as well, that they can't get their hands on the cash to make it work on a daily basis, part of the working capital. I suppose there's inefficiencies across all the intercompany. Then you have a case of where you've got problems with settlements, increased exposure to FX, where FX hasn't been looked after because there isn't that visibility on the consolidated basis by the treasurer. Okay. Yeah.
So a lack of standardization of both banking partners and process,
which results in a bit of chaos, I guess, without it.
Yeah. Okay. And I guess then conceptually, the in-house bank is trying to bring some of that standardized process and structure to a global level to allow multinational organizations to manage that.
Correct.
I mean, it is interesting that you say that. You hear the same things, same issues arising in companies, anything from revenues of 1 billion up to 200 billion. They all seem to have the same issues, and certainly there's significant pressure, I think, on the treasurer to be able to get their hands around this, and it is daunting. It's a difficult thing to do. As you say, you're looking at organisations that are in a lot of different geographies. There could be several hundreds of different banking partners in some cases, hundreds of bank accounts. So really, it's trying to get your hands around that.
Correct.
And the in-house banking structure and solution is a way to go about that.
It is, because it's like once that is in place, there's a clarity that comes with it. It centralises the cash, it brings it all together. It'll reduces your costs, your borrowing costs. You've got access to that cash that you might be borrowing inefficiently otherwise. It also offers the opportunity to bring in the intercompany netting into that as well, which again creates massive efficiencies in the number of FX you have to do. It reduces the number of settlements. As a result, you've less chasing of settlements and manual error and a host of things that can feed into that.
Yeah, great.
Yeah.
So look, let's break it down. So you know what? An in-house bank, it can be a big concept and it can be sort of a lot to digest, I suppose. Like what are the, if you break it down into its constituent parts, what are the normal things that you would see, the normal processes that you would expect to see being housed in an in-house bank or being managed by an in-house bank?
Within the in-house bank, I suppose you have managed, your FX is managed within it, your intercompany loan portfolio is wrapped up within it, and the intercompany netting, you have your forecasting is part of it, and you will have all the reporting from each of those subsidiaries scattered all over the world are all brought into that one structure.
Okay.
Yeah. So giving you, I suppose, a consolidated view of all those little not little, but the big elements within the company that are all brought in under that one umbrella.
So cash and liquidity management, pool management.
Yeah, your daily cash management comes into it. So you have your notional pooling, physical pooling, whatever type of pooling structure you decide to go with.
Yeah.
It all comes in under that. So on a daily basis, you could have your pooling structure across 20 currencies. It's being gathered from all over the world, and you're able to consolidate that currency view and ultimately manage your FX then through that.
Yeah.
Again, like I said, reducing the number of FX as a result of it, which brings down your costs, brings down your borrowing costs, your fees with banks, that it's all in that one cash management structure.
So
at the end of the day,
getting your hands on available cash and using it
for the day to day,
in the most efficient way.
Yeah.
Like, we're talking about multinational organizations and driving efficiencies, Eileen. Like, at the end of the day, the cash is generated at a local level in most cases, right?
It is.
So, like the in-house bank does have a role in that sort of domestic cash management. I'm thinking particularly in the US, for instance.
Yes.
You know, how do we see that being managed? Like, do we see that being part of the in-house bank?
Yes, you do. You see it as part of as part of the in-house bank account as well.
Yeah. So there's an element of domestic cash management, and then a sort of an international overlay or a group sort of
correct. So at the local level, they are, the responsibility is often put down to the local level to manage that cash, and then ultimately for the treasurer then to be able to have that open communication with the local level to access that cash and move it on up.
And then, so that's one bundle of cash, but like in the case where for regulatory reasons or operational reasons, cash pooling isn't possible. Yeah. Intercompany loans are the answer, are they?
They are, 100%. So the standalone intercompany loan, which you may have in that instance, which again is very easy to manage. It's just, and I suppose it's wrapped up within it, so you still have the visibility, even though you mightn't necessarily be able to get your hands on that all the time. At least you can manage the FX that arises out of those positions in those restricted currencies and countries.
And manage the working capital flows in and out of those
exactly
areas as well.
Which you can still do. It's just there's probably an extra little step in there within the overall structure. But,
so cash and liquidity management, intercompany loan management, they're the bread and butter of the in-house bank in terms of the cash. But very often then we would see people add on things like intercompany netting. And cash reporting, cash forecasting. I mean, they're all
they're layers.
Tools of the treasurer.
They are.
And probably all have been made a lot easier with the kind of common rollout of standard ERP systems across multinational organizations as well. It's very interesting. So like, I suppose we've talked about there about the sorts of processes that we generally see in an in-house banking structure. Like, what are the benefits that a treasurer can expect to extract from that?
I suppose the top for me is it takes away all the chaos. You've got smoother internal processes and controls as a result. So you're freeing up your team to work on more strategic type projects that might be running along, as opposed to chasing stuff that that wasn't adding any value in the first place. It also gives that standardization across all the controls and the processes as well.
Like financially. You're getting your hands on, you're getting your hands on
an enormous amount of cash.
I mean, typically I think our clients have their hands on an average of about $500 million worth of cash daily cash as a result of these processes.
And they're getting invested then into the money market funds and the deposits and
paying down debt at maybe 5% or something. You know, so substantial financial savings. I know sometimes we focus in on the process savings.
Because the borrowing costs, obviously, with drawing down in debt are enormous, depending on the size of the borrowings that you have. So and the fees associated with that. And again, so...
And then the softer benefits, I think, as well, that a lot of our clients would quote, like, for instance, with netting, you're just, deflating all of those intercompany balances, which can cause a big mess.
They can. And
they can cause FX exposures. They cause cash flow issues at a local operating level. And really, when you're centralizing all that through the intercompany netting and the in-house banking system, you're wrapping all of those
you're wrapping it up. And you're taking away the manual error that's associated with all those processes, sending payments all over the world,
So benefits that you've outlined are the use of cash
Yes.
We're getting what's available and maybe earning nothing at a local level. We're getting it back to the centre, and we're repaying debt or investing or whatever. We're standardising process, and we're reducing risk as well by standardising process, and also, generally implementing a small number of partner banks rather than a fragmented approach.
Yeah.
There's lots of other things, right? Like
there is. Sorry, I was just
implementation of FX, cash flow hedging.
The automation that comes with it all.
Forecasting possibilities.
Yeah.
These are all things that we see tagging on.
Which make enormous differences and bring, like I said, tangible savings to the whole process. Yeah.
So a whistle-stop tour, but a lot in it, right?
Yes, there is, yes.
Yeah, it's very hard to kind of make it so succinct.
They're all big in their own right.
You could spend an hour discussing any
any
one of those topics. Yeah, very interesting.
Yeah.
Thanks, Eileen.
No worries. Thanks.
Folks, thank you very much for taking the time today to listen in to this very brief discussion that we've had about how in-house banking solutions can help bring efficiencies in multinationals. I think, there are probably struggles that all of us can recognise, and some people are further down the road in terms of solving them than others. But no matter what size of your organisation, you can probably identify with some of the things that we've mentioned, be they kind of fragmented banking relations, lack of access to cash, FX exposures, intercompany issues. These can all be solved with relative ease by implementing an in-house banking solution. We provide all of these services on an outsourced basis to a wide range of multinational clients and can provide the technology and infrastructure required, as well as the expertise to implement in a very short time frame and in a very robust control environment. So look, if you'd like to discuss any of these with us in more detail, please don't hesitate to get in touch with us. You'll get all of our details on our website. That's www.ftitreasury.com. Thanks again for joining us today.